All right, good afternoon, everyone. This is John Cook, the Senior Investment Analyst here at iSectors. I'd like to thank you for joining me today to review the most recent iSectors performance data. I'll be giving just a brief overview of the first quarter performance for all of the iSectors models, while also touching on how certain models performed in April as well. I won't be sharing full performance results. Those are always available on our website at iSectors.com should you ever want to take a deeper look at any of our models. This call should last about 20 minutes with a short question and answer segment at the end. Please feel free to ask questions anytime during or after the presentation by clicking on the chat box in the lower right-hand corner of your screen. This presentation will be recorded and a copy will be available on our website tomorrow. Click on the iSectors magazine icon under the Editorial and Media tab, and it will take you to a link to access the recording. We will also be sending a link to access a recorded copy of this presentation to all webinar attendees immediately after this call. So with that, let's start with our post-MPT allocations. Both the iSectors post-MPT moderate allocation and the iSectors post-MPT growth allocation outperformed their benchmarks handily in the first quarter. Over the past year, as of April 30th now, growth has just about matched the S&P 500, while moderate has outperformed both its 60/40 benchmark by almost 10% and the S&P 500 by about 6%. Returns so far this year have been positively affected by large energy allocations and, to a smaller extent, gold miner allocations in both models. And also, both strategies have been hurt by their weightings to long-term treasury bonds and technology stocks. And so, looking ahead, speaking on those long-term treasury bonds, post-MPT growth, as you can see in the chart on the right, has greatly reduced its treasury bond allocation over the past few months, since October of last year, actually. And at the same time, it's increased its alternative stocks allocation, which, as you can see, alternative stocks, as we define them, are real estate, energy, gold miners, and basic materials. So it's over the past 6 months or so, it's been slowly ticking down its treasury bond allocation, slowly ticking down its traditional stock allocation, quote unquote, which is technology, healthcare, financials, and utilities, and really ramping up, as I mentioned before, the energy and gold miners allocations as it currently stands today. And actually, the only traditional stocks in post-MPT growth as it currently stands are utilities. So even there, even amongst the traditional sectors, it's pretty defensive. So now that's post-MPT growth. Speaking of post-MPT moderate, it's also increased its alternative stock allocation to some extent, but in remaining true to its lower risk profile compared to post-MPT growth, it has kept a higher long-term treasury bond position. And this has certainly been challenging in the current interest rate environment we're in right now. But the cross correlations and diversification offered by the other sectors that moderate has been allocated to has helped it perform, as you've seen, has helped it perform relatively well recently, despite the challenges we're seeing with interest rates right now. So, in moving on from that, it brings us to our favorite chart that we like to present on pretty much every webinar we give and every PowerPoint presentation we put together. So, this chart plots average returns for the 200 plus rolling 12-month periods for both the S&P 500 and the post-MPT growth allocation since 2005. And now these 200 periods are separated into 3 buckets that you can see here. And so if we're going from left to right, the first bucket is when the S&P has a negative rolling 12-month return. The middle is when the S&P has single-digit positive returns between 0 and 10%. And then the farthest right is when the S&P has double-digit positive returns. And as you can see, and as has been the case so far here in 2020, post-MPT growth does pretty well when the S&P is negative or moderately positive. It will lag when stocks are climbing at a rate greater than 10% annually. And so the insurance aspect of the strategy that we use for post-MPT growth, we get there through the treasury bonds and alternative stocks that I mentioned on the previous slide. It's helped protect the downside big time this year. But that insurance aspect and that protection has a cost, which is underperformance in strong markets, which is what we saw in late 2020 and 2021 when the model underperformed. So, we show this chart every presentation, but it's really powerful and it's probably the best encapsulation of what post-MPT growth, and moderate for that matter, the moderate version of this chart tells basically the same story. And if you reach out after, we'd be happy to show you the moderate version of this chart. But it sums up how post-MPT performs and has performed using those 200 plus months or 200 plus periods of the rolling return 12-month data as evidence of that. Okay, moving on to our pure equity models. The iSector's domestic equity allocation outperformed the S&P 500 both in the first quarter and in April. And our global equity allocation also outperformed its MSCI ACWI benchmark in both periods. Both strategies were helped mostly by dividend-focused ETFs. The chart on the right there, as you can see, it plots the S&P, or the Spider S&P Dividend ETF, which is SDY, versus the Vanguard Growth ETF, VUG. And it plots those returns it's hard to see, but going back since November. And you can see there the outperformance that those dividend stocks have provided in that period. And so SDY, the fund, it tracks an index of companies that have increased their dividends for at least 20 consecutive years. And I show this here because it's a pretty good example of the kinds of ETFs we utilize as a part of the dividend tilt we employ in both the global equity and domestic equity allocations. So in 2022 so far, our crypto block suite of models, the iSector's crypto block allocation and the iSector's crypto block 2 allocation have both struggled in 2022 so far. Mainly, it doesn't help that Bitcoin's price has fallen back down towards $30,000. It's bounced a little bit, but it struggled. Crypto block 1 has direct Bitcoin exposure through the Grayscale Bitcoin Trust, which is GBTC. But Crypto Block 2, it only utilizes equity-based ETFs to gain adjacent Bitcoin exposure, and it has a much heavier focus on pure blockchain technology companies. So if you'd like more information about how to access these models, please contact us, as they're not available on all the same platforms the rest of our models are, but we will certainly be happy to discuss them if you'd like after the call. Okay, our fixed income allocation. So the iSector's domestic fixed income allocation outperformed its Bloomberg aggregate benchmark year-to-date and over the past 12 months. The iSector's global fixed income allocation has done the same versus its FTSE World Government Bond Index benchmark as well. For both of these models, the shorter duration profiles have really helped reduce the losses so far this year against their benchmarks, which are both longer duration, as you can see summarized in the chart on the right. Global fixed income does have a little bit longer duration than domestic fixed does, but it's still shorter than both the Bloomberg Ag and the FTSE World Government Bond Index, and that has been the main driver so far this year of the outperformance against their respective benchmarks. So on this slide, the iSector's enhanced balanced allocation is going to serve as a representation for our entire enhanced allocation series. These models, as a reminder, are blends of our other previously mentioned model offerings: domestic equity, domestic fixed income, and post-MPT growth. All 5 models in the series, ranging in risk from income to aggressive, have a 20% allocation to post-MPT growth. And it's just the allocation between domestic equity and domestic fixed that varies based on the risk level. So as you can see in the chart on the right, enhanced balanced is balanced between domestic equity and domestic fixed income. And as you get, that scale slides as you go on the different risk categories from aggressive, growth, balanced, conservative, and income. And so speaking on enhanced balanced itself, it outperformed its comparative Morningstar moderate target risk index in the first quarter and year-to-date as of April 30th, and also over the last 12 months as a whole as well. And that is representative of the entire enhanced series. They've all been able to outperform their Morningstar benchmarks over recent periods because, as I mentioned, as you saw, we only have domestic exposure in our target risk allocations, whereas the Morningstar indexes do have some global exposure in there. Okay, the iSector's inflation protection allocation gained 5.45% in the first quarter. And while the iSector's precious metals allocation increased by over 8% during the quarter. And through the end of April so far, these two models remain the only positively returning models in the entire iSector suite. They're still positive even after the rough April that was had across almost every asset class. So positive returns from commodity funds and global resources ETFs have helped boost returns in the inflation protection model. Gold and silver holdings have aided performance in both allocations, however, which makes sense for precious metals. So if you look at the chart on the right, it's a return comparison of the Aberdeen Physical Gold ETF, SGOL, compared against the Spider S&P 500 ETF, SPY, SPY, and the iShares Aggregate Bond ETF, AGG, which is those are just the ETF representations of the S&P 500 and the Bloomberg Aggregate Bond Index that we use as some of our benchmarks. And you can see gold has and this is again going back to November. I know that's hard to see. Going back to November, gold has looked much better, and that's kind of indicative of other alternative investments as well. I'm just using gold here kind of as the standard for that, even though the story would be the same with broad commodities or global resources, like I mentioned earlier. So that just goes to show why and how these models have been able to outperform this year. Okay, moving on to the iSector's liquid alternatives allocation. It outperformed its hedge fund benchmark in the first quarter of 2022 and over the last 12 months. The biggest drivers of the outperformance, or the protection, I guess I should say, would be hedged strategies and real asset exposure. As you can see the percent of each of those categories here on the chart. Those were the main drivers of positive returns in the first quarter. Alternative equity ETF exposure, things like micro caps or like an IPO index we have exposure to, that hurt the results of the strategy, both in the first quarter, but especially in April. It was really rough for them in April. Okay, the high income focused iSector's endowment allocation outperformed its benchmark year to date and over the last 12 months. High dividend equity ETFs and business development companies have aided returns so far. High yield bond ETFs have been the biggest drag on performance, both year to date, I guess, both first quarter and in April. So with a current yield over 5%, endowment is still an excellent solution for clients who are more focused on high current income than total return, which we've gotten a few requests for that so far this year. The iSector's Tactical Global Balanced allocation outperformed its benchmark in the first quarter, in April, and over the last 12 months. The bearish positioning of the model has been the biggest reason it's been outperforming too. So between February and up until now, the strategy has fluctuated between 40 and 70% in cash alternative holdings, with the most recent positioning, as you can see in the chart on the right, as of the 1st of May, being 70% short-term bonds and cash alternatives. Commodity ETFs also did help results because it's been invested. It's had a position in broad commodity ETFs since the beginning of the year. They've helped in the first quarter and in April. So just so everyone remembers too, that this model, it's a momentum-based trend following strategy with the ability to invest in several different asset classes, many with a low correlation to each other. And it also has the ability to pivot to 100% short-term bonds and or cash alternatives if the model deems the market unfavorable, kind of like it does right now. Okay, and so speaking of cash alternatives, our capital preservation allocation, as you can see in the chart on the right, it's earned over 2% on an annualized basis over the past 12 plus years. The yield on the model is attractive compared to cash, and it has a short duration that's protected against rising interest rates so far this year. During the first quarter, it decreased about 1.7%, but which is still an outperformance against its short-term government bond benchmark. So that brings us to the end. That's the last model I'll be presenting today. And as you read through the disclosure page, I'd like to once again remind everyone that full return data is available on our website or upon request. We've even run custom reports in the past, so please don't hesitate to reach out today to myself or Scott Jones, whose contact information you'll see on the next slide, if you have any questions about specific models or certain historical time periods. Okay, now we can begin the question and answer portion of the webinar. If anyone has questions, you can type them into the chat box in the lower right now. And I'll see also if anybody has submitted anything during the presentation. Okay, so I got a question about how much international exposure is in our global equity allocation compared to our domestic. Well, obviously the domestic won't have any international exposure, although these dividend heavy companies that we like to invest in, they do get about 30 to 40% of their revenue overseas. But still, with that notwithstanding, our global equity strategy is about 2/3 US, 1/3 international. So that also helps explain how it's been able to outperform its ACWI benchmark, because ACWI is closer to 50-50 US and international. So global equity, we do have a domestic overweight, but because those domestic ETFs we're investing in, the dividend ETFs, they still get a lot, 30 to 40% of the revenues overseas. So it brings us in line on an effective basis, I think, to the benchmark, but on an absolute basis, it is about 2/3 domestic, 1/3 international. And then, okay, we have another question coming through. How often is tactical global balance rebalanced? So I'll go back to that slide. So similar to our post-MPT models, which are the only other tactical models we have, tactical global balance rebalances once a month, monthly. It uses price change data from month to month that we use as part of the trend following strategy we employ. The post-MPT models, they also are rebalanced every month, but it's a completely different process, quantitative process. It's not tactical global balanced momentum strategy is fairly simplistic, and it's still given great returns, especially recently. But post-MPT's process is much more sophisticated. The only similarities really between the post-MPT models and the tactical global model is that they're run monthly. So, okay, go back to the contact page in case anyone needs to reach out to us. I'm not seeing any more questions, so I wish to conclude by thanking everyone for attending our webinar this afternoon. And if there's anything we can do to assist you with your wealth management or asset allocation needs, please let us know. If you have any questions we didn't get to, we can be reached directly at 800-869-5184. Hope everyone has a great day.